One thing we didn't just mention right now is the CET ratio falling to 9.9%, declining by just about 3%. That's kind of the cushion that banks have. How should investors view that?
Yeah, I think taking a step back, investors should view the banking industry, particularly the largest banks, as in a great position from a capital perspective. All the banks obviously passed this year's stress test. If you dig into the results a bit more, the results were mixed relative to last year. Some banks were a bit better, some banks were a bit worse, but on balance, everyone passed, and the industry is in a great capital position. We've been talking about obviously the stress test, something that is probably not going to be a huge event. We're moving more toward the Basel III endgame, which is another big regulatory capital overhaul, and we'll have more insights on that most likely in August, but that's been developing positive. So we've been pretty constructive on the bank industry's capital position, and actually as we get to Basel III endgame, I think capital return could accelerate more materially.
All right, so back to that CET ratio. Not a concern in your mind at all that it actually declined?
Yeah, for the largest banks, not a concern in the stress scenario. So obviously, there's a few banks where they came down a bit more than we would have liked to see last year, and some were up a bit relative to the last year. But these are all kind of small nuance. I think the largest banks, which are the ones that are stressed here, all performed well, and we would expect Friday we're going to get two capital return announcements. I'd expect modest improvement overall relative to last year, but again, I think the bigger capital return story is going to come on the other side of Basel III endgame. So,
all right, Devin, before we skip ahead to Friday, give me a second. Before we skip ahead to Friday, I want to talk about the stress test right now. So we talk about commercial real estate quite a bit here on CNBC, but the Fed said the drivers of the decline are actually credit card delinquency and riskier corporate credit portfolios. Is that an area of concern for investors?
Yeah, I think for the large banks, again, they're so diversified, and so you did see some stress, and that's part of what drove down the CET1 ratios in this test. But the banks still overall came out in a good spot because they have such good diversification at the largest bank level. I think as you go kind of rungs below that into some of the smaller regional banks that obviously have more concentration, it's an area that we're more focused on. I think investors are more focused on. So again, it's something where we knew that there would be some stress in this test, and ultimately the banks came out in a good spot given what are really severe scenarios that the Fed is putting these banks through.
You mentioned you're expecting two capital return announcements tomorrow. What banks are you expecting to get the return from?
Well, I think sure. Yeah, I think we're going to get announcements from obviously everyone, or for the most part everyone. I think that the largest banks are in a good position to at least modestly accelerate return. But kind of to my earlier point, I think there's going to be some reluctance to get too far ahead of kind of where capital rules are going to shake out here. The good news is there were some press reports earlier this week that Basel III is continuing to get softened a bit here, and that's been the expectation over the past few months. So that's really good for the banking industry. And so as we get to kind of the final rules on Basel, which potentially are coming in August, that's going to be, in our opinion, a big catalyst for this group to really think about accelerating capital return, particularly some of the banks that have been holding back and just looking for more clarity there.